Now, Brandon, let's talk about how we decide whether we want to insure on just one life or whether we want to use a second to die policy.
Yeah, so when we talked about the different product types, those products are manufactured whether we want to insure one life or do we want to insure two lives. So these same insurance carriers will manufacture a product where they're insuring two lives, but they're not going to pay the death benefit until that second death happens. So even though they're naming two insureds, if that first insured dies, you have to keep on paying the premium until the second insured passes away, and that's when the death benefit would be paid off. So in that situation, we're trying to figure out when's that tax-free liquidity needed. When's that death benefit going to be needed for our family farms or ranches? So if it's truly maybe to pay for federal estate tax, that's where that irrevocable life insurance trust is going to own a second to die because we don't need the death benefit until the second death. Or maybe it's for estate equalization. We don't need the death benefit until the second death. And the reason we look at a second to die product on that side is because it's much more cost effective to insure two lives than it is to insure one life. And we can still get the same no lapse guarantee rider. We can still even probably get some of the same features like a long-term care rider or a chronic illness rider on a second to die. It's just, is that what the intentions are for that product within that plan design?